This video will take you through 3 different depreciation methods. Using information that you can find on your text of page 625, there's some information about this particular type of equipment. The cost of it is $900,000. The salvage value is $60,000, and its useful life is expected to be 6 years. Doing straight line depreciation, note the formula shown in blue. The depreciation per year is $140,000. With that, we create what's called a depreciation schedule. And each item over here in the first column shows the depreciation for that particular year. In the second column is the original cost, which never changes. In this next column, we have accumulated depreciation. Notice that it increases by the amount of depreciation each year. By the end of the 6th year, we have depreciated $840,000. And when you take cost minus accumulated depreciation, that will give us the net book value. Notice that it has changed from $760,000 in the first year down to its residual value of $60,000 at the end of year 6. Note, we can never depreciate less than salvage value. So we have to always be sure that we can stop at that salvage value, in this case, $60,000. That's the most commonly way that we do depreciation in the US, and mostly because of its simplicity. Now, units of output. That's an activity-based one. It's actually sometimes more accurate in some ways. So because we have a coal mine going on here, notice on page 625, they gave you the amount of coal that was actually used for each of the 6 years. But in the beginning, we really didn't know. So there's an estimate that takes place at the beginning of the project, just like we do for straight line. We estimated the salvage value of $60,000, and we had an estimation of 6 million tons of coal that would be depleted over this thing. So it ends up being a rate of 0.14 per ton. But that doesn't mean that's our depreciation. In order to get depreciation per year, we take the tons of coal that were actually mined that particular year and multiply it by our rate. Notice that our rate stays at 0.14 during the entire 6-year period. Notice that there's fluctuation in the actual amounts of coal that are mined. In that way, in some ways, you could see this depreciation expense may be more accurate if the wear and tear on the asset is related to the amount of activity it gets. So we multiply for each year the number of tons of coal times 0.14. We also have to keep that constraint that we can never go below $60,000 on our net book value. So at the end of the 6th year, it turns out this company was perfectly spot on when they made that estimate of 6 million tons of coal. Because if you add up what's been done over the 6 years, it is exactly 6 million. If they had mined more than 6 million tons, then we would have to just stop depreciating, and they could continue to use the equipment, but there would be no related depreciation expense with it. Moving on to the third method, which is called double declining, and it is a little bit of the toughest of the 3 methods. You may apply this using makers in tax, for example. They have double declining balance and sometimes 150% declining. But using double declining, what we do is we take 2 divided by the useful life. So in this case, 2 divided by 6, which ends up being a fraction of 1/3. The straight line rate, of course, is 1 divided by the useful life. So anyways, 1/3 ends up being 33%. What's different about this one is how we go about getting depreciation expense. Notice we haven't done anything for that residual value yet. We take the beginning net book value. The company, what is net book value? It is cost minus accumulated depreciation. In year 1, there's no accumulated depreciation. Therefore, cost minus accumulated, the net book value, is $900,000. We multiply that by the rate and we get the first year's depreciation expense. Then we show end of the year depreciation, the end of the year balance, and now we see the net book value at the end of year one. We take that and then we multiply it by the amount, the same percentage, 0.33, and we get decreasing amounts of depreciation over the life of the equipment. You would never actually get to depreciate all the way, because if you keep taking 33% of something, it keeps getting smaller and smaller, but it'll never go to zero. So companies there's one or two ways you can deal with this issue, and the one that we're going to use here is when we get close to the end of the useful life, let's go ahead and make sure that the last year reflects the remaining amount of depreciation expense. So notice in this little note in year 6, the original amount of depreciation was going to be 39,506. And the remaining scrap value then would show, or the book value would show 79,013. The useful life we said was 6. So we take the difference between 79,013 and we subtract out the 60,000. So that additional amount, 19,013, is added to what would have been the depreciation for year 6. Okay, so if you need to stop, rewind, listen to that again, but we increase the depreciation in the last year to knock out anything remaining and get it down to its book value. The last part of this problem is now finding the gain or loss on a disposal. So at the end of year 3, we change our little play here. We sold it at the end of year 3. The selling price in each case is $450. The net book value is found in each of the 3 depreciation schedules. Notice that under straight line, cost minus accumulated is $480,000. It was, when we take the difference, we see we have a loss of $30,000. Under units of output, same cost in the beginning, same selling price. The net book value at the end of year 3 was $382, leaving a gain of $68,000. And in the third year of double declining, we see that here 266,667 was the net book value. That gave us a gain of $183,333.